China is a no-go zone. There are too many restrictions. The policies are impossible to predict, and foreign investors just can't adapt. If you're an international investor, you've heard these concerns, and perhaps shared them. But here's the reality. Much of the difficulty stems from outdated mental maps. Using a 2015 playbook for 2026 markets is like navigating with paper maps in the GPS era. To find alpha in 2026, we must first upgrade our 2G mental software to the 5G reality. To see the real China, we must first unlearn what we think we know. When the 2026 government report set the GDP growth target at 4.5% to 5%, critics immediately labeled it a ceiling or a sign of decline. Yes, this is a step down from the historical 8 to 9% pace. But equating slower growth with peaking misses the fundamental pivot from quantity to quality. The real story is in the industrial backbone. Consider the sheer scale of its industrial base. China is the only country with a full industrial system under the UN classification. In 2025, China's electricity generation was double that of the US, and its auto sales were twice as high. Its output in shipbuilding, crude steel and cement surpassed the US as well. We're witnessing a massive structural pivot. The focus is now moving away from real estate and towards advanced manufacturing and tech-driven growth. In 2025, China's real estate's drag is being offset by a 13.9% surge in high-tech sales. Beyond that, China's R&D expenditure now accounts for 2.80% of GDP, surpassing the OECD average for the first time. With a middle class of 400 million and growing, China isn't peaking. It's maturing into a sophisticated complex of high-end manufacturing and consumer power. The old playbook was infrastructure, property, and exports. The new playbook is about innovation, advanced manufacturing, and domestic consumption. The world's factory has evolved into the world's lab. The image of China as a low-cost assembly hub is obsolete. The nation has transitioned from a follower to a leader in the most critical hard tech sectors: AI, quantum computing, and biopharma. While Silicon Valley captures the headlines, China is rapidly scaling humanoid robotics in Shenzhen and Shanghai. Companies like UB Tech and CloudMinds are already deploying robots in industries like manufacturing, healthcare, and service sectors. In the pharmaceutical world, Chinese innovative drugs are no longer just domestic players. 2025 was the breakout year for Chinese pharma. License-out deal volumes hit a staggering $135.6 billion. Chinese IP is now a global commodity. Companies such as Beijing and Innovent Biopharma are making waves globally with international clinical trials and increasing license-out deals. If you still believe China only copies, look at DeepSeek. When their AI model dropped in early 2025, it didn't just match Western performance, it did so at a fraction of the cost, sending shockwaves through global tech markets. By the end of 2025, China had 6,200 AI enterprises with a core industry value exceeding $173 billion. AI-related industries are expected to exceed 10 trillion yuan by 2030. Investing in China today isn't about cheap labor. It's about tapping into the world's most efficient ecosystem for turning cutting-edge technology into global-scale reality. Ignoring these tech advancements could mean missing out on some of the most transformative opportunities in the global market. The final myth is that the regulatory environment is an unpredictable maze. Admittedly, the volatility of the past few years required a strong stomach, but context is everything. Check out the trend lines. In reality, China is opening up more sectors to foreign investment and shrinking the negative list from 190 items in 2013 to just 29 in 2024. This includes key industries like finance, automobiles, and manufacturing. The regulatory storms of the past weren't about closing doors. They were about clearing out monopolies to protect fair competition. More importantly, China's long-term policy direction is becoming more consistent. Decarbonization and tech self-reliance are top priorities. Industrial upgrading strategy is clear and predictable. In a world of global uncertainty, this consistency offers a rare form of strategic certainty. Moreover, China isn't just opening the door for newcomers, it's rolling out the red carpet for existing investors to expand their footprint and commit for the long haul. Free trade zones like in Shanghai and Hainan are aligning more with international standards. 9 additional cities joined comprehensive opening pilots in telecom, healthcare, and finance. A 10% tax credit now applies to profits reinvested in encouraged industries. China isn't as unpredictable as it may seem. Here, following the policy map isn't a burden, it provides a roadmap for investors looking for reliable returns and a competitive advantage. The real challenge is understanding the changing market landscape, not fearing sudden policy shifts. China's investment landscape has evolved. Clinging to old perceptions of cheap labor and unpredictable policy is like using a map of the 20th century to find a 21st century gold mine. The opportunities are there, but they belong to those who look beyond the headlines and see the structural transformation of a global giant. The question isn't whether China is investable. The question is, are you using the right map? Beyond the noise, into the alpha. Don't forget to subscribe as we dive deeper into the 5th 10th 5-year plan in our next episode.